Welcome back. Welcome back to the 43rd episode of Coffee with Krav,
Mhm.
where I have conversations with different people from different walks of life, where I'm looking to educate, entertain, and have some fun. I'm really excited about today's guest. We're going to talk about everything you always wanted to know about the economy and the markets, but we're afraid to ask. Well, I'm not afraid to ask. We will cover the new administration, the present economy, the trends in the markets, and where the opportunities are. So, without further ado, I bring you Stephanie Link. Let me start by reading her bio. Stephanie Link is the Chief Investment Strategist, Head of Investment Solutions and Equity Portfolio Manager at Hightower Advisors, a national wealth management firm that provides investment, financial, retirement planning services to individuals, foundations, family offices. In addition, Stephanie runs multiple equity strategies within the Investment Solution Group. The group is managing many billions of dollars of clients' money. Prior to joining Hightower, Stephanie was the Senior Managing Director and Head of Global Equity Research at Nuveen, where she co-manages the CREF stock variable annuity portfolio with $200 billion in assets, managed her own U.S. core portfolio with $3.7 billion in assets, and oversaw 33 investment professionals who collectively managed $40 billion. Before joining Nuveen, Ms. Link spent 7 years at The Street as Chief Investment Officer and co-portfolio manager of Jim Cramer's charitable trust. Unless you're hiding under a rock, you've seen Stephanie on CNBC as she frequently appears on the halftime report, Squawk Box, Closing Bell, and Power Lunch. Okay, Stephanie, let's start at the beginning. As I understand, you have a lot of your family that's been in the financial services industry. Did you just like sit around the campfire and talk about Eastman Kodak and IBM stock? What was it like growing up like that?
Well, Happy New Year, and thank you for having me, Mark. Well, it was an interesting upbringing, if you will. We didn't necessarily talk a lot about stocks per se, but we talked a lot about just big picture and like the markets at large and the economy and what was happening globally. And it was business discussions. And that started like right in the beginning, like when I was 5 or 6 years old, I used to spend time in my father's office. And it started there. And then as I got older, the conversations got more sophisticated, and it was really quite interesting. They are all in the advisor world, like yourself. And I actually decided to take a different route and go more institutional. And so that was also an interesting conversation going back and forth with my family. But I will say this: the being involved with and being around the financial services industry all my life, what I did learn while I took a different path, what I did learn was really to find financial independence. And that was something that my father, right from the beginning, had really focused and really honed in on for me the importance. And so that's really what I was after. I wanted to be in the financial services industry. I wanted financial independence, but I just decided to take a different track, and that's probably just for the best.
Oh, obviously it is. Now everybody has their mentors. Who was some of your mentors?
Yeah. So well, first I was very lucky. I've already mentioned my father. He was a huge, and he still is a huge mentor. And by the way, he's still at 87 years old, part-time advisor. So he certainly has had a really big impact on my career. And also just the fact that he also likes to work out. His work ethic and his working out ethic really has been very much important to me, and it's been really wonderful to kind of follow in his footsteps. So that's one. I think that other mentors, I was very lucky. My very first job on Wall Street was on a trading desk at a company called Dean Witter.
Mhm.
I'm sure you remember the name. It doesn't exist anymore, but Dean Witter
Stocks
and
and socks.
that's right, Stocks and Socks.
Stocks
And
and socks.
because Sears owned them, right? So they merged with Morgan Stanley back in 1996. But I started there, and it was a trading floor of about 500 people,
Mm.
and three were women. I was one of three.
Wow.
And that was interesting. But I was very, very fortunate that the two gentlemen that I actually worked for, because I was an institutional sales assistant, I worked for two gentlemen that were in the business for 30 to 40 years at the time. And they really were very pro women and wanted me to succeed. And I often tell the story to people today that you have to find mentors. You have to find people that are going to help you because they can advocate for you on in terms of senior management, but they can also guide you, and they can see very often where your path can go or the options that you have without you really knowing it. Because when you're right out of college, you don't really know what the heck you want to do, right? So
Right.
that was I was very fortunate there, but I was also um, very lucky that my father's next door neighbor, the Rita and Doug Skolnick, of all people, they were wonderful. They were both at Bear Stearns, and he was the chief financial officer, and she was one of the head fixed income bond traders. And I just looked up to both of them as this power couple. And she took me under her wing as a
Mm.
female, right? And she was really rooting for me along the way. And I just always used to pick her brain about, well, what do you see for me, and how can I be successful? What does it take? And so it's that coaching and that guidance that really helped right from the beginning and to set the standards very high and to actually try to exceed from those standards.
Well, I'll just say that you've exceeded all standards. So
Oh, thanks.
we'll, uh,
That's sweet.
we'll start talking about let's start by talking about the economy. Where are we in the economic cycle right now?
Well, I would say that the last 2 years have been positively surprising on GDP growth.
Mhm.
We grew 2 years ago, we grew 3.4% in GDP. And last year, probably we haven't had the final numbers, but we're close to 3%. Recall, Mark, and I remember you and I both had this conversation 2 years ago, most people were expecting a recession.
Session.
A
Yeah.
recession 2 years ago.
Mm.
Not only did we not have a recession, but we saw above trend growth, So above trend is about 1.5% growth. And so that has been a positive, that had been a positive development. And the reason we saw above trend growth is really because of all the fiscal and monetary policies that were put in place throughout COVID and even after COVID. And that, in fact, you've heard me say this number, but if you add up all of the fiscal and monetary policies that were put in place throughout COVID, that was equivalent to 60% of US GDP. Back in 2008, with the great financial crisis, and it was a crisis because we
Mm.
lost some very big banks.
Yep.
It was really a scary time. If you added up back then the fiscal and monetary policies that were put in place, it was 5% of US GDP.
Wow.
So it's enormous the amount of money that was put in. And as you know, it takes a long time to get that money. Just because you announce policy and you get it approved and all of that, it takes a long time to get into the economy. And so what has helped the economy. Unfortunately, all of that money, while it led to better growth, it also led to more inflation. And so at the peak, we saw 9% inflation. That number has been coming down, thankfully. It's still pretty stubborn at about 3% now. And that's because we have continued to grow more than expected. So fast forward to today, where do I see it's going?
Yeah.
And to answer your question directly, I think 2025 is a little bit harder of a setup because you're not going to have as much fiscal policies that were put in place. It's still there, but it's just not as much. And that is then the offset would be you have the Trump administration having very pro-growth
Right.
policies, right? Lower taxes and deregulation and that sort of thing. I do not think that tariffs are going to lead to inflation. I think you're
Okay.
going to see more targeted tariffs. I think China is in deep trouble. I think they're going to see 30% tariffs. There's no, in my mind, no question. And that's a low number, but that's the number I'm using. Could be higher. I think I think this the rhetoric on Canada has certainly been heating up and Mexico as well. But I think that will be less in terms of tariffs. And so we'll see what he imposes throughout the world as well. But I don't think when he just ran on a policy of we've got to get inflation down, that he's going to all of a sudden put in place policies that will see massive inflation. So I think adding it all up, I think this year you could probably see about 2% growth, not the 3% that we're seeing, but that's still above trend. And why do we really care why we're growing and what we're growing, what the number is? Well, we care because in a 2% GDP world, you can see kind of mid-single digit earnings. And if you add margin upside expansion, which I think we will see, you could see upper single digit earnings growth. And my good friend Larry Kudlow taught me 18 years ago, stocks follow profits on the way up and on the way down. And so numbers have been going higher throughout the last 2 years in terms of earnings, and I think they'll continue to grind higher. That being said, there are some people out there that expect to see 15% earnings growth. I just don't see it because you just don't have that underlying thrush in the economy that's going to really enable the economy to grow in that big of a way. I mean, 3% is a big number, but 2% is really good and something to be excited about too. So I know we've had a great 2 years in the equity markets, north of 20%. Last year, the equity markets, it was the 24th best year ever in performance in history. And the
Wow.
NASDAQ had the 15th best year in history. These are wonderful numbers. We should feel excited about it, but I would not expect another 20% plus in the markets. But that doesn't mean we can't grow. We can't see 5 to 10%. The long-term total return in the S&P is 7.7%. So I think you're going to see maybe a little bit higher than the long-term average. And I hope I'm wrong, and I hope we do see another 20%. I just don't know if we're going to get there.
Okay. So the Fed obviously is very, very important, and where they're heading, and they're talking about two more rate cuts this year. If you had to take an over/under on that, or right at it, what would you say? Do you think we're going to get to two? You think we'll get more? You think we'll get less? Or what do you think?
Yeah. I mean, I think that because we're going to continue to see good growth in the economy, I think inflation will stay elevated. Maybe it's the 2.5%, 3%. Maybe it gets closer to 2.5%. The goal, as well as I do, is from the Fed is 2% inflation. And so it's been stubborn though. And I think you're going to really have to get that number down. And in fact, yesterday we had a number, and this is very, very short term, but yesterday we had an ISM services number that was off the charts in terms of strength. We know services have been very, very strong in the economy, but it also brought with it the highest prices paid in 2 years. And that prices paid is just an indication of inflation, right? And so it was the highest in 2 years. So that's a bit concerning. So I think that the Fed, as a result of inflation staying a little bit more elevated, I think you're going to see something like 1.5 to 2 cuts. I think that's pretty much what you said the market is expecting. If we could make more progress on inflation, then I think we will see more cuts. But at this moment in time, I think it's really hard to make the case to have any more than that, just given again the dual mandate of the Fed. They look at inflation and they look at the labor market. And oh, by the way, the labor market continues to be very solid. We had a job openings number yesterday that was much better than expected. We had weekly initial claims today that was much better than expected. So the labor market is okay. And so the Fed really wants to focus on the inflation piece. And if you listen to Chairman Powell in his last presentation, he actually did indicate, yeah, we're really, really laser focused on inflation and trying to get that number back down. And so that's the number we're going to all have to watch.
Is 2.5% inflation so bad when we're growing like we're growing? Is that a big deal? I mean, I don't know. It seems like a decent number. Do we really have to get back to 2%?
I do not, I totally agree with you 100%. And on halftime CNBC yesterday, I got into a little bit of an exchange with Scott Wapner, the host, on this very topic, because I said exactly what you just said. If we're growing at 2.5% GDP and we're seeing 2.5, 3% inflation, that's not terrible. What the problem is that
What does Scott know?
I know.
He's just a host. He's
He's
not
just
like you.
he
Yeah.
tries to
Well,
stir it up. Yes,
yeah, exactly.
he was definitely stirring it up. So I 100% agree with you. Like I would, to me, Mark, I would much rather have better growth and a little higher inflation than the opposite, right?
Mm,
And I speak from an investment point of view. Nobody wants inflation, right? And as a consumer, I get that. But from an investor, a little bit higher growth and a little bit higher inflation is so much better for profits than the reverse because companies will have pricing power and they do
mm,
have pricing
right.
power in a higher inflation world. And so, and at the same time, our US companies are amazingly run well, amazingly. They are very focused on profitability. And that's why when I mentioned earlier about margin expansion, I think you
Hmm.
will see continued margin expansion because companies either they have the pricing power or B, they're just so efficient and they're cutting costs and they're restructuring and that sort of thing. The one thing to keep an eye out for on the inflation front is productivity. If productivity actually gets better, and I think about AI, we all think about AI and
Hmm.
technology in terms of productivity. If we can see a 2.5% productivity number, that certainly will help and go a long way on the inflation front too. So there are a lot of puts and takes, but I'm 100% in your camp in terms of let's 2.5, 3% is not the end of the world. At law, and my point being is I don't see even in a 2.5% growth world, do I see inflation going from 3 to 5 or 7 or back to 9? We're just
Hmm.
not going to see that.
Right.
Not in my opinion anyway. So, and again, we have an incoming president that's laser focused on inflation. And he's very well aware. I mean, he's a real estate mogul at heart, right? And so he knows all the puts and takes to inflation.
So speaking of real estate, I wanted to get your thoughts. I mean, with rates where they are, I wanted to get your thoughts on real estate. What do you think about real estate at this point?
So I think a couple things on real estate. Like I believe that there are pockets that you are very attractive to own and to be involved with in terms of like distribution centers, fulfillment centers. Um, and there are places where you don't necessarily want to have exposure. I think office is really still, even though it's very tempting because it is so down and out. I think office has changed because of COVID and because there are a lot of companies out there that will never go back to 5 days a week of people in the office. And so that
Mhm.
has changed. I think malls have done a great job in terms of converting from stores to experiences. And so I think that's an opportunity. Let's see what office decides to do. They're going to have to convert probably to, to residential or to others, but it's very hard. It's very challenging from a regulatory point of view to do that and takes a long, long time. So there are pockets of real estate that I think you can own. It's certainly great for a diversification tool. And then I would say on residential, in terms of housing, you've heard me say this. I mean, I think housing is a 10-year, decade-long theme positively because we are structurally short homes in this country. We're 5 million homes short in this country. And we have underproduced for 14 consecutive years. You ask any home builder, they'd rather buy back stock than build out on their land.
Mm, right.
So you also have 5 million millennials that are first-time buyers that want to own a home. Now, 7% mortgages, 30-year fixed is not going to help. It's not going to do it. So this is not a short-term call per se, but this is very long-term because I just think structurally the supply demand is such an interesting phenomenon. And I don't think that that's going to change. So I think, this year we'll see what happens to rates. Uh, we know that President Trump wants to have rates come down. We'll see if they can get that done. And you probably need mortgages to get to something like 5% to get real demand,
Mhm.
but you'll get it, and eventually we'll get there.
And speaking of Trump and the new administration, they have the new Department of Government Efficiency, DOGE. Um, Tough job to reduce the exploded debt, right? Any thoughts on that? I just wanted to get your take on that.
I think it's going to be very hard for them to cut what they're saying, the dollar amount of what they're saying. 2 trillion is a lot of money.
Mm,
Are they going to make progress? Certainly. Are they going to increase efficiencies and productivity? Of course, where they can. I have no question there. But I just don't know if it's going to make a big enough dent in our debt. I will also say I'm not really sure how to square the circle or circle the square, whatever that phrase is, on if he wants to lower taxes from 21% to 15, like that's going to cost an awful lot of money as well. And so I'm not 100% convinced we're going to see substantially lower taxes. Maybe they just stay where they are, and that would be perfectly fine,
mm,
especially for corporations, right? But there's a lot of puts and takes. I have said this in the past. No matter who won this election, Harris or Trump, they are both spenders. They just
mm.
spend differently. And so I'm just not sure you're going to see massive declines in our debt levels, unfortunately. And unfortunately, Mark, your daughter, my daughter, they're probably going to have to deal with the debt problem versus us.
Yeah. Um, um, just looking at the world, world governance is changing rapidly, right? Germany, South
Yeah.
Korea, France, Canada. Do you think that this will have an effect on the international markets, maybe even a positive effect on the markets? Just wanted to get your take on that. And then, uh, similarly, in that international markets have not reacted the way that U.S. markets have been. U.S. exceptionalism, right? I wanted to get your take on the beaten down international markets, emerging markets, and will they finally, maybe 2025, start to outperform or at least perform equally to our markets?
We have seen across the spectrum in various different countries I don't want to say a movement. That's a little strong, but it's definitely a moving towards more on the right side of government, being more fiscally responsible and focusing on the debt levels, focusing on the growth. You've seen it across the board, and that's really, I guess, a function of really we went the other way for the last several
Mm,
years, and that has led to slow growth. It hasn't seen international markets have not grown that much, minus India, which is one of my bright spots. I like India very much, but India is the bright spot. The rest of the world has certainly have had struggles. We know what's happening with China. They barely can get to 5%, and they're offering all of this kind of stimulus. Europe has been in the doldrums for years, and they has seen not only a slowdown in growth, but their inflation is coming down, so they can actually be more aggressive, and they are being more aggressive in terms of lowering rates. And that brings me back to, yes, U.S. exceptionalism, and by the way, that's led to a stronger dollar. So you've got to keep an
mm,
eye out on that, because while we like a strong dollar, it's not so great for multinational companies that have to convert, right? So you've got to watch that piece of it. But I will take exceptionalism. I will take above trend growth in the United States. I will take our transparency in terms of our companies and what they offer to investors any day. And I think the beaten down international names, companies, and countries, certainly if we see more pro growth policies like the United States, I'm not sure you're going to see as aggressive pro growth strategies as much as more just being more fiscally aware. But if we saw a little bit more pro growth strategy, certainly that would be a positive for sure, especially the valuations being where they are. This one thing that I always struggle with, though, Mark, like I look at, okay, China is to me uninvestable. If I want to own China, I own a US company that has China exposure there, because China has no transparency. Japan has been a good economy and a good market. Last year was a great market,
yeah.
and they're doing the right things. And it's a cheap area in terms of a country to own. Europe has always I've always struggled with because it's so incredibly cheap and the margins at these companies are so incredibly depressed. And you think, oh my gosh, there's so much upside, but they have so much regulation. So it's very, very hard for them to actually kind of lay off, restructure, reorganize. So they have a lot to deal with. And so it's cheap for a reason. And that brings me back to India. And India is going to grow about 6% this year. Sure, it's not going to be the 8 to 9% that we had been seeing over the last couple of years, but 6% is pretty substantial. They have all kinds of initiatives, pro-business, pro-growth. They have Prime Minister Modi, who's going to spend $1.7 trillion on infrastructure between now and 2030. Between now and 2030, they're going to become the #3 country in the world. And they are continuing to focus on their consumer. They have 1.42 billion people in their country. And 40% of those people are under the age of 25. So
Mhm.
just think about the productivity and the growth that you might see going forward. This is also another decade-long theme
Right.
for me. It maybe, will ebb and flow and that kind of thing. So I think you want to be careful. I mean, I think there's always a place for international exposure in your portfolio. I personally wouldn't have any more than 5 to 10% in my portfolio. And I find, quite frankly, I can get international exposure from US multinational companies if I want to do that.
Okay. So what do you think is going to be the best performing asset class this year?
Oh boy.
It's an easy
That's
question.
it's a good question. I think the best asset class will continue to be equities, but it's not going to be the 20% kind of growth that have become accustomed to. I do think it'll beat out bonds, but I do think cash is going to, if rates stay where they are, cash will be a competition. And I think private equity also will be competition, and there's always a place there too. I think this year is going to be about having a diversified portfolio. It's not going to be 100% stocks. It's going to be, maybe it's 70-30 stocks to bonds. Maybe it's 70-10 bonds, 10 cash, 10 private markets, but it should be equities because over the long term, as I mentioned earlier, that has the superior S&P 500, the large cap equities have a superior return over time.
All right. Well, speaking of large cap companies, the top 8 companies on the S&P make up around 40% of the index. Is that dangerous? Is that a bubble forming? I know we talked about U.S. exceptionalism. Is this going to continue? What's your thoughts on that?
I think this year you're going to see more diversification. I think those 8 companies that you mentioned, the Mag 7, 8, whatever the top technology companies, large cap, they're wonderful companies. They have amazing franchises. They have incredible free cash flow generation, and that is super important. But they have had a really nice run. They're quite expensive. What I worry about is they're quite over-owned. So who is your incremental buyer of these companies? But they're wonderful, and you want to have some exposure to them for sure. However, if I'm right and the economy is above trend and earnings continue to be solid, then it's not going to be only the Mag 7 or 8 that will produce good earnings. It will be all the other companies that have good earnings. And I'm talking about industrials, anything tied to power and the grid and electrification. I'm talking about the consumer. We just talked about jobs. The labor market is fine. Wages are going higher, inflation is coming down. So consumer discretionary companies, I think, will do well. I think financials, wait until you see the fee growth that's going to come out of the financial services industry when they report earnings later this month and throughout this year. If you believe in deregulation, the financials will absolutely benefit, not only from having less capital requirements that they have to have, but more, they will be able to benefit from the activity, the M&A, the pipelines, and that sort of thing. And so with all of that comes higher fees. And I think that's going to be the bright spot. And oh, by the way, a steeper yield curve will also help their net interest income, which would be also a positive on top of this other of the fundamentals. So I think there are other places to be involved in. I think energy is certainly interesting. It's washed out. Nobody wants to talk about energy. Nobody owns energy. It's only 3% of the S&P 500. You know, back in in the 80s, 1980s, it was 18% of the S&P 500. So it's come a long way on the downside, and I think that maybe there's a nice mean reversion idea there as well.
Okay, so energy 3%. You think it can get to 5%?
I think it could. I think it could. And it would surprise a lot of people because once it goes from 3 to 4%, all of a sudden generalists come popping out of the woodworks, and they say, "What am I missing? Why should I own these? Why should I own this sector? I haven't had to own this sector." Here's the reason why you want to own this sector: because the companies are minting money at $70 oil. Even if you think that Trump is going to be successful in terms of drilling more and encouraging companies to drill more, and the price will come down as a result. Even at $50 oil, they're still making money. They are break even at $35 a barrel. So anything above that is gravy. And what they have been doing is, yes, they're producing, but they're also returning that free cash flow to shareholders via dividends and buybacks and that sort of thing. And so they're awfully cheap. And they're off the like everyone owns technology, no one owns energy. And so if you want to be a contrarian, which is kind of the way I run my portfolio, because that's where you really tend to make the money, the big money, because it's all of a sudden, you know, you get to buy something when it's cheap, and then if people decide that they want to chase, and then go for it, and I benefit.
So speaking of contrarian, any specific areas or stocks or places that you like on the contrarian side?
Sure. I'll tell you what I like a lot. Areas in terms of controversy would certainly be in the sectors that I talked about that are just unloved, and that certainly is energy, it's materials. I think that cybersecurity, talk about another theme, decade-long theme. We're going to have, I think, cybersecurity is just as big, if not bigger, than AI. And I think that is because we have a real problem. We have a real problem.
Mhm.
We have too many cybersecurity companies that don't talk to each other, so that our companies that utilize many different vendors, they have issues. So I talk to CTOs, including our Hightower CTO. They will say, I wanted 10 vendors because I didn't want to be hostage to one. Now I want 3 to 4 vendors because I want those 3 to 4 vendors to talk to each other and to offer more security. And so that's what I think you're going to see. I think you're going to see massive consolidation. By the way, there are 6,000 cybersecurity companies in the world.
Wow.
So I think you're going to actually see massive consolidation. I think the big get bigger.
Oh, excellent. Well, that was great.
By the way, I mentioned supply chains and how a lot of companies are moving their supply chains out of China into the US. Guess where else they're going? They're going to India.
India.
So, in fact, if you ask Tim Cook, he produces one iPhone out of every 7 in China. Excuse me, in India. He wants to get that one out of every 4 iPhones are produced in India over the next decade. So that's the kind of theme that I'm looking at, and I'm really appreciative of when I think about India. But it's also very important to consider, what does that do to China? And do they have to do more in terms of stimulus? They do, and they will. But it's going to take a long time.
Excellent. Well, Stephanie, you've said it all. Probably not. You haven't said it all. You said a lot, but we all tremendously appreciate. Is there any parting words? Anything else that any questions that I didn't ask that I should have asked, or anything that you want to add to all this wonderful information?
You always ask all the right questions. I know you and I
Oh,
could
please
probably sit and talk
stop.
for seriously. I mean, I love doing interviews with you because it's just a nice conversation, and you hit on all of the important points and all the points that people are talking about and focused on. Um, Watch just one last thing. Watch the bond market. The bond market, I'm an equities gal, and but the bond market is 4 times the size of the equity markets. And so they're pretty smart. They kind of know what they're doing. watch bond yields. Bond yields are creeping higher. If we got to 5%, I don't think the equity markets will like that so much. And look, remember, we always have pullbacks. It's normal. It's
Right.
healthy. It gives you an
Yeah.
opportunity. So don't be afraid if we see a pullback. That's why all your clients need you so much, because you can keep them calm, you keep them diversified, and you know what all of the things to do in a correction. I'm not calling for one, but I just wouldn't be surprised if I'm looking at the bond market and the bond market does not like higher yields, at least above 5. So that's just something that I'm watching. And but look, I always worry about something. I worry when I don't worry because that means I'm complacent, right?
Mhm.
So let me and Mark, you and I, we will worry for your clients.
That's right. That's our job. That's our job.
That's
Well,
our job.
well, Stephanie, thank you so much for participating with Coffee with Krav. The next Coffee with Krav will be March 18th with Dr. Kate Truitt. She is a neuroscientist and clinical psychologist that has dedicated her life to advancing treatment of trauma and stress-related disorders. She's been on Oprah, Today's Show, BBC, and she's finally made it to the big time. She's coming on Coffee with Krav. So we will see you then. Thanks so much, everyone, and have a wonderful day. Take care. Thank you.
You.